Hello and welcome to a brand new show of Market Makers. My guest on the show today is indeed a special one, someone who I've always maintained is one of the best stock pickers on D Street, Nilesh Shah of Envision Capital. Nilesh, what a delight to have you back. Thank you for joining us.
Thank you, Nikunj.
How would you characterize the big picture for us? Because markets are not doing too badly, but they are not doing very well either.
Well, I think the big picture is that probably the worst is behind us in terms of macros. I see a situation where the macros could only get better from here, thanks to the softening in commodity prices and a lot of initiatives which the government has undertaken. I clearly think that the translation of these positivity in the macros to the micros could still take a few more quarters. And I clearly believe that maybe 3 to 4 quarters down the line, the micro picture could look a lot better than what it looks today.
But is all the macro adjustment in the price already? Because earnings have not expanded, yes, and the market P multiple has expanded.
Yeah, if you really look at the earnings, this has probably been now the 5th year of a single-digit earnings growth. So from an 800 rupees EPS on the Sensex, we've now come to about 1200 rupees, which in 5 years, it's appreciated by 50% in terms of the EPS. And the Sensex in 5 years has not gone anywhere. So if at all from a 5-year perspective, we've actually seen some contraction of the P multiples from the highs of 20 plus to about 17, 18 times trailing earnings. So to some extent, there has been a marginal contraction in P multiples. And the market will probably remain in this range. I don't think there's a case for a P expansion till the market see any improvement coming in at the micro level, which could be a factor of cut in interest rates, could be a factor of the cut in commodity prices translating into better margins for corporate India. And third, of course, is the final leg would come in when you see some traction on the sales front. I think these are the 3 important triggers which could play out over the next 3 to 4 quarters from a corporate India and a micro perspective.
Do you think globally and locally a lot of complacency has kicked in? Genuine growth is not back. Central bankers are committed to print money, and somehow everyone is convinced that liquidity will take care of all the bad news.
I believe that globally, I think there's a fair bit of complacency which is crept in. I think that in India, in the case of India, I still believe that there is a very large camp of the disbelievers saying is that neither will the macros improve and therefore the micros not improve. But the big risk, I think, for the global economy, global markets, is going to be more about competitive currency devaluation. Clearly, you see a lot of economies globally. There is now a race to depreciate your currency or devalue the currency. Of course, it's triggered off significantly by Japan. And you're now beginning to see a clamor in a lot of countries across the globe to basically start depreciating the currency. If that happens, then that's not going to be a good situation to be in, because that automatically means a strengthening dollar, and a strengthening dollar not necessarily means good news for equity markets. So I clearly believe that that's the big risk, and this is all happening in an environment where actually China has gone in for an appreciating currency. If China were to respond to what Japan is doing, the way in between it responded geopolitically, if it were to kind of respond from a currency perspective and stop this appreciation of its currency and go in for a depreciation of its currency, then I think that's basically, that would really be bad news for both the global economy as well as for global emerging markets.
As of now, Indian markets are lagging developed markets. So Dow is sitting at a new historic high. Indian markets are struggling to cross 6,200. Do you think in next 2 quarters or after 3 quarters, we could move independently of global cues? As of now, we are a function of global cues. We are hostage to global liquidity.
Yeah, and I clearly think that that scenario could still last for another 3 to 4 quarters, where we'd be really dependent and contingent on global liquidity. And if the risk on shifts back to risk off, then obviously India could be essentially in the short term a victim of that. But what I clearly see happening over the next 3 to 4 quarters down the line is that growth rates which say corporate America has posted in terms of bottom line growth, that could kind of moderate. And I clearly see earnings growth in India begin to pick up. So today, for example, the growth differential between earnings of corporate America and corporate India is virtually not there. Probably both are growing at 7-8%. I don't expect corporate America's earnings to grow into double digits, whereas India is well positioned to get into double-digit earnings growth, maybe with a lag. And I think once that starts to happen, that's probably the time you'd see the outperformance of Indian equities versus global equities start to come in.
Is it time to prepare for the next bull run or too early for that?
No, I think it's time to prepare. I don't think you're going to basically get a notice in advance. I think you have to start preparing for it right now. Keep looking out for companies which will still kind of, do well, get into double-digit earnings growth, grow better than the market, and obviously not have balance sheet related issues. So I think if one starts looking at that kind of a situation, one needs to start preparing for that.
Do you worry about the polarized nature of the market? 10, 15 stocks are moving up, that's about it. Rest of the market is stationary, mid-cap stocks are languishing. That's not a very healthy market. That is not how a bull market will typically start.
Yeah, I think that's really been the big worry over the last few months. I mean, if you really look at over the last 18 to 24 months, the nature of the rally and the nature of the way the market has been performing is getting even more and more narrower. So if you look at 2 years back, there were at least 30, 40, 50 consumer stocks which were kind of, rallying and things of that kind. Now that's basically getting narrowed down to maybe just half a dozen names, and entire liquidity started moving there. If you look at banking 2 years back, by and large, there used to be some kind of a euphoria for virtually all banking stocks, all financial stocks. Now that's again getting narrowed down to maybe now half a dozen stocks. So you're right that I think the rally is getting narrower. But that's really the way the bubble gets built. So if you really look at 2000, where the Sensex made a new high, but that it was entirely driven only by technology, and then towards the fag end, it was again driven only by a handful of technology stocks. So yes, I think that's clearly a worrying sign. But I think one has to really look beyond that and look for opportunities which could then play out over the next 3 to 5 years.
We've argued in the past, why should you buy consumer names? Why should you not buy consumer names? There are endless arguments, I guess, on both the sides. What is your argument?
Well, I think if you look at the consumer space, I clearly believe that in India it's going to be hard to find a consumer name below 20 PE multiples. So I'd say that 20 plus is the value zone, 30 plus is kind of the fair value zone, and 40 plus is essentially the euphoric zone,
so
or the mania.
Bubble?
So I clearly believe that yes, it may not crash or anything, but I believe that yes, a lot of these stocks which are trading at 40 plus P multiple, I'm not sure whether there are incremental returns to be made from these kind of companies. And if you look at the last year has not been very good for a lot of these companies. I mean, they've delivered less than 15% earnings growth, a handful of some of these consumer companies. If you look at really the March quarter balance sheet of these companies, they're sitting on some pretty high inventory, on high receivables, which I don't think is a good situation to be in. So clearly I think some kind of a slowdown is there. And these companies would still do well over the next 5-10 years. But I think when you buy these stocks at 40-50 P multiples, I'm not sure whether there are returns to be made, particularly from a 3 to 5 year kind of horizon.
So let me give you an example here. HUL is trading at something like 35 times, part of the index. You got Kane India, part of the index, trading at about 4 times. So at the current juncture, is one better of buying Kane, a commodity company, no one likes it, markets just love to hate that stock, or one is better of buying HUL, where the global parent has made some commitments and the business is growing in a tough environment?
I think the two probably may not be very comparable. It's quite possible that HUL can keep outperforming. Because clearly it's still in a position to show that 10-12% odd kind of growth numbers. Kane, on the other hand, is an out-and-out commodity. And you have the big risks that if today oil is trading at $100 a barrel, if oil goes down to even $80 a barrel, that would be huge for somebody like a Kane India. So it may not strictly be comparable. But having said that, I think clearly from an outperformance point of view, I'd probably think that Kane has the potential over the 6 to 12 months, maybe outperform a name like HUL, given the fact that it's trading at 4 P multiple. So even if that 4 were to go to 6, it could translate into a 50% upside. Whereas in the case of HUL, whether that P multiple of 35, 40 can go to 50 or 60 P multiple, I don't think that would be a very rational case to kind of project. So I clearly believe that on relative valuations, it's quite possible that some of these cyclical names have a chance to outperform from a 1 to 2 year time frame.
I guess everyone is convinced that there is a lot of global liquidity. Central bank communication also has been clear that they would like to follow a loose monetary stroke accommodative monetary policy. So in an environment where earnings are not growing but P multiples are expanding, is one better off staying with quality stocks? Yes, quality stocks are expensive, but that is where all the action is. Why jump off the bandwagon?
Yeah. I think the mantra is always stay with quality, irrespective of market situations. It's a question of whether, I think at times what happens is that quality is referred to only by the large caps and the mega caps, but I still think that there's a lot of quality names, even in the tier 2 space or the mid cap names. So I still think that yes, the mantra is that stay with quality, because I think if you're in a bad company and if it keeps kind of every quarter coming in and doing some provisioning, or it goes in for a CDR or something like that, those are the kind of root shocks that one can be in, and I don't think there's an environment where you can afford to kind of have those kind of root shocks. So I still believe that the mantra is to be with quality. We're still in an environment where global liquidity is going to drive direction, it's going to drive sentiment, and I think global liquidity is going to get into quality stocks, irrespective of what the valuations are. It may not be the right thing to do from a medium to long term perspective, but I think they'd probably get into stocks where they can deploy $50 or $100 million on an overnight basis, and that's why you're seeing some kind of this mania built up in some of the large consumer names where valuations have virtually gone to 40 times.
So what is quality, what is cheap, and what are you buying?
I think to us quality means profitable growth. I think that's clearly without expanding the balance sheet too much. I think that's clearly what our focus on quality. So I still think look out for companies which are zero or low on debt, companies where promoter holding is reasonably large, there is skin in the game, and essentially that they are managing themselves well in this kind of an environment, not depending too much on external capital to fund their growth. I think to us, this is what quality is. And I think if you are in stocks like this and you're paying a reasonable valuation for it, I think that's probably the optimal strategy to be in.
Give me an example.
I think we're looking right now, for example, a lot of the tier 2 consumer names. So we dwelt a lot on some of the larger consumer names, and all of them are probably between 35 to 45 times. But I think if I had to look at some of the select tier 2 consumer names, which are in areas like fashion and apparel, which are into health and wellness, which are into consumer products, consumer durables. I think if you still look at a basket like this, we still see a lot of quality names driven by outstanding Indian entrepreneurs at valuations between 20 and 25 times, growing between 15 to 25%, carrying zero debt, generating a lot of cash flows, have net cash in the balance sheet. I think this is kind of a basket which I believe you're not paying too high a price and still has the ability to deliver you good absolute returns over a 3 to 5 year time frame.
So give me an example so that I get a sense of where you're tilting.
I wouldn't again want to get into individual names, but I think that each one of these businesses are very, very difficult businesses. And I think if one can still look at individual companies where individual brands are becoming north of 100, 200 crores, individual brands, and where over the next 5 years, because of the burgeoning middle class, the aspirational middle class, improving affordability, I clearly believe that individually in some of these brands could even become 500 crore brands and throw 100 crores of cash flows every year. And I clearly believe that that's one really segment to focus on.
So mid-cap consumer strong brand owners, that is your next big idea?
Yes, I think that's one important pocket, which I believe is getting overlooked right now by the market, because I still think the market is finding comfort in some of these larger names, irrespective of whether the valuation is being 40 or 45 times. So yes, I think mid-cap consumer names across discretionary, non-discretionary spending, I think is an excellent place to be in.
You were hot on mid-cap IT last time when we met. Are you still hot on mid-cap IT?
Oh, absolutely. I think we like that space. We clearly believe that, again, some of these mid-cap IT companies are run by exceptionally good management teams. They have a differentiated business model, which means that they are not vying for those same 200 or 500 or $1 billion annual contracts, but have got their niche in terms of their technology domain. Again, have an excellent balance sheet, zero debt, growing at about 15-20%, and available at 10-15 P multiples, which I think is a good situation to be in. And they do not have significant headwinds of growth, in the sense that a lot of the larger IT companies are still struggling with even a 5 to 10% growth, whereas these kind of companies, for them, I probably believe that 10% should be a floor in terms of growth. And if the environment turns a little better, they could grow at about 15-20%. And with valuations at about 10 to 12 times, I think there is tremendous value again from a 3 to 5 year horizon.
Do you own any Nifty 50 company in your portfolio?
No, we don't own any Nifty 50 company.
On a 15% decline, which is one Nifty 50 stock you would like to buy?
I think on a decline, I probably think that it would be one of the financial names. I think that's probably the space, because we've clearly seen now that a lot of the financial companies are able to still grow pretty well in this environment, maintain asset quality. And I think on a 15% decline, they could present a good value.
Out of the three new age banks, Yes Bank, IndusInd Bank and ING Bank, which one do you like?
Okay, I think clearly if you look at it, I think on a pecking order basis, as of now, the tilt would probably be more in favor of ING Vysya Bank, purely because of valuations.
The cost to income ratio is very high.
But I probably believe that that's also the scope for improvement. Okay. Because I think they have been a little light in terms of business growth. Their focus has been 2 or 3 years back to kind of come in, clean up, improve asset quality, and then go for the big haul. And clearly seeing that strategy play off now. Probably the next 2 or 3 years, they should probably do as good as any of the other private banks in terms of their growth. And we clearly believe that valuations are still at a discount versus the other two names which you mentioned. So I probably think that on a relative basis, from a pecking order, I clearly believe that ING is more better placed compared to the other two on a valuation perspective.
But a genuine investor, to your mind, at the current juncture should have a strong exposure to banks. You don't think the private banking story or the private banking trade in India is over? I
don't think that trade is over. But I'd probably still avoid banks which are at 3 or 4 times price to book. The situation today is that really those top rung quality banks are trading at north of 3 times price to book, FY14 situation, which I think again leaves very little on the table for investors. That's been
the story so far for HDFC Bank, and they've still managed to grow.
Yeah, but that's like one exception.
Okay.
That's not necessarily the situation. I mean, we've also seen a lot of other private banks aspiring to grow at those rates, but have not been able to grow at those kind of rates. And one has to also keep in mind is that, probably this is one sector which I think globally, which has got always rewarded for diluting equity. Nowhere in the world, and probably not even in India, do you see where an entity gets rewarded for diluting equity. And here it's that typical that you cash in on your higher valuation, so you basically dilute at 3 times
But money is the raw material for a bank.
It is the raw material for a bank, surely, but at the end of it, you're still diluting.
EPS is coming down.
EPS is kind of, dilutive. Your book value is dilutive because of that. So that's the situation. I mean, as long as they keep growing like this at 25-30%, it's pretty okay. But I think with new competition coming in, with some of the NBFCs getting smarter and doing well, I'm not sure how sustainable will this 30% growth be for some of the banks.
When and where do you think the new leadership for the index will emerge? Banks have done their bit. FMCG names are trading at multi-year high. For IT, there is no growth, and for commodities, there is a degrowth.
Yeah, I think this is a very interesting kind of a situation to be in, and maybe I think for a few more quarters, the leadership would still continue to be with the incumbents. Which is the consumer, private banks, pharma, the defensive bet. I think that's clearly where leadership will continue to be in. But I don't think that inflection point is too far away where, cyclicals come in. And especially I think on the engineering and the capital goods side, that's a space that we've been monitoring very carefully, but we've still avoided it. But I think there are a few companies which again have exceptionally good managements. They don't have baggage of the past in terms of high debt, or they've not gone in for provisioning because they don't need to do it. They sell some quality equipment competing with multinationals. They have an edge, again, from a delivery perspective. So I probably believe that, it would be hard for Indian markets to make substantial new highs without the investment cycle kicking in, and some of the names which are best proxies for that investment cycle coming in and giving you some solid appreciation. So I clearly believe that that's one big opportunity which has underperformed for the last 5 to 6 years, but maybe over the next 5 to 6 years there's a better chance of outperforming.
Tempting as it may sound, but is one better off giving a skip to infrastructure stocks? They're attractive, they're cheap, but somehow promises have not morphed into reality.
Yeah, I still believe that it's still a very difficult space to be in. I think headwinds are still very strong. I don't think the entire policy rollout across the board has happened. So it's still a very, very challenging sector to be in. But I think if you slice it up and say that, okay, you want to avoid the asset-heavy guys.
So no GBK, no GMR,
if you kind of still avoid that space, if you avoid the conventional contracting guys, and still kind of, stick to guys who deliver equipment, who make components for various of these capex-oriented projects or infrastructure projects, then I think you might have a good chance of finding quality.
So what is on the radar here?
So I think still companies like, say, Thermax, LG Equipment, Greaves, I think there's a reasonably good basket which you need to keep watching and probably strike when the time is right. I think there is an upside potential here.
How does one judge the market timing here?
I think the best indication of that is basically the order books. I think, it's not necessarily that you're going to be able to catch that in advance, but I think when you clearly see the managements of these companies kind of being a lot more positive in terms of order book accretion, I think that's the time. If you kind of listen to the managements of all these companies, I still don't see them being positive on their order book accretion, at least for a couple of quarters, if at all maybe the entire financial year. But it's quite possible that 6 months down the line, if the government decides to go ahead and spend, give go ahead for a lot of projects, and if interest rates come off, you might see the order book accretion beginning to happen. I think a classic example, and I'd like to kind of connect with what we started off talking about the global situation, that, for example, Japan has depreciated its currency significantly, which means that on the railways front, you have the Prime Minister of Japan wanting to commit and bring its high-speed rail technology to India. Now, if that were to happen and kickstart, I think that's a huge positive, because the cost of setting up any such project would be down 10, 15, 20% versus what it would have been 2, 3, 4 years back. So in that context, I think there are some attractive opportunities which are beginning to come up. Now, one has to really find out that which individual company could be beneficiary of that.
So at Envision, what is your current portfolio strategy? Last time when we interacted, you were cautious. You made a point that the best part of the trade is behind us. It's time to delve into mid and small cap stocks. Are you taking some deep dives anywhere?
Yeah, I think our strategy by and large has remained the same, that we continue to be very careful before investing. And I think we continue to be focused on mid caps. I still think that even today, as we speak, we're still biased towards the consumer names. We still believe that there are some few companies out there available at very attractive valuations. We've continuously evaluating both the agri and the capex space. And I think, again, we're probably just waiting for the right environment to allocate capital out there. So I think we continue to kind of have a reasonably balanced approach to our investments.
So let's play our favorite game, the acronym game. Last time it was RICH. What's the new one?
No, I think RICH continues. I think it's a very relevant acronym.
Which is Reliance, Infosys, Kane, and HPCL.
Yes, I think these stocks at least continue to just be probably market performers. They've not kind of as a basket outperformed the market. But one is beginning to see, I think there's a fair bit of pessimism on most of these names. And I clearly believe that they have underperformed now for years as individual stocks. And I think that, again, from a slightly medium to long-term perspective, they have a good chance to outperform.
So if you have to customize a portfolio for a client and your mandate is you cannot look outside Nifty 50, identify 3-4 stocks for us.
Again, I think...
I know that's not your style, but if there is a requirement, I'm sure you can do customization.
Yeah, I know, but again, 3 to 4 stocks I think would come in from 3 to 4 pockets. I'd still say that look at tier 2 consumer names, some of the larger capex names, some of the names in the agri space which are very balanced, not too dependent on government subsidy. I mean, of course, all of them are too dependent on the government subsidy or government initiatives, but I think that's one. And then I think look out for a cheap, efficient private banking or an NBFC space. I think these are 4 or 5 kind of opportunities or sectors that one would be focused on.
Over the years I've known you, you've always been a growth investor. You've never chased value. Do you think now it's time to chase value?
I think over a period of time, what I believe is that value comes from profitable growth. And I think that's something which we'd love to kind of, look at, evaluate, and bring it in the portfolio. So I think just low P multiple really doesn't make any sense beyond a point. As long as the low P multiple is just because it's not adequately tracked or something like that, then obviously to us that is value. But I think is that the priority is that one should, in a growth-oriented economy like India, you generate alpha by investing into growth at a reasonable price.
There's a whole maxim on Wall Street that fund managers, they always learn in their 30s, they inculcate in 40s, and they always make money in 50s. So you're reaching there.
I don't know about, for me, I think learning will be a continuous process. So, I mean, I still think that, I probably need to learn and will keep learning over the years and over the decades. To me, this is a marathon, and so one will always learn at every step of the marathon.
But the best is yet to come.
Oh, absolutely. The best is yet to come.
Nilesh, really appreciate your time and good luck for your future ventures.
Thank you.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.